Welcome to another masterclass. Now in this masterclass, I'm going to take you through transfer pricing. आप सबको पता है DT final में, in DT final, we get transfer pricing for approximately 8 to 10 marks every paper. One of the critical aspects is not just to understand it, to be able to visualize, because most of us are not able to visualize the international transactions or associated enterprises. Of course, we are taught them. हमें बताया जाता है वो क्या है. But to be able to visualize, to be able to solve queries, you must understand how the transaction is taking place. So in this masterclass, 2 videos which we've used a lot of visual effects. I will not call animation, visual effects, because we are not entertaining here. We are trying to teach you. All your memory is in the form of images. So what we are trying to do is, while reading text, we will also be able to help you visualize the same by taking you through a lot of animation, a lot of visualization of that particular Bear Act, so that you are able to read it with me, visualize it, and then of course, and we will be doing a lot of questions. So we will understand the various methods, what happens if there is more than one appropriate method, how do you calculate the mean and how do you apply it, will there be penalty, what is an international transaction, what are associated enterprises, all of that in such manner, taking you through the reading of the Bear Act, the examples, the past year's questions, and helping you visualize the same. So enjoy yourselves. For any questions, any doubts, I'm always available on WhatsApp. Chapter 10 of the Income Tax Act, one of the more important provisions, both for your papers, the concept of transfer pricing, and of course in the practical world. As we see the world becoming a smaller place, we see a lot of companies operating out of different countries. What one must understand is that each country will have a different tax legislature. Countries like Singapore have very low tax, Mauritius, Cyprus, British Isles, Cayman Islands. Now, all of these countries have differential tax regimes. So you will find, because Singapore is in the center of the world, you will find most of the big companies will have an office there. They will have their head office there. They might route their transactions through that particular head office. What they are going to try and do as a company, their basic aim is to reduce their overall tax liability. So if in the US, they're going to be taxed at 40%, in Singapore, they're going to be taxed at 1%, in India, they're going to be taxed at 40% plus surcharge and cess. They might want to show more of their profits in Singapore than in India. Now, what Indian government wants is that their tax base is not eroded. So, base erosion, profit sharing, one of the concepts that we will be doing during the course of international taxation. What this chapter does is to understand that if there are associated enterprises. Now, the definition of associated enterprises is going to be given under section 92A. Under 92A, the basic concept is, if there are entities that have control over each other or in some way are influencing the price of a transaction. For example, let's say there's an Indian entity. I didn't say branch, Indian entity. It could be a separately incorporated company or a firm or an individual, any person. And there is an entity in Singapore. And by applying 92A, there is what we call association, or they are associated enterprises. Now, how they can manipulate the tax in India is, the Indian resident, if he is selling to the non-resident, can under-invoice. If he is buying from the non-resident, can over-invoice, so that his expenditure in India will increase. So, there could be sales into India or sales out of India, and by manipulating the price of that transaction, the profits in India could be under-assessed. Or maybe in Singapore there is a head office. By allocating extra head office expenditure to the Indian entity, they could be reducing their tax liability in India. So, by reducing the value of outgoings from India or increasing the value of incomings into India, or apportionment into India, they might manipulate the profits. What chapter 10 says is, in case of associated enterprises for an international transaction, what is an international transaction will be covered by 92B. there will be the provisions of arm's length price, which means we are going to determine the price at which this transaction would have been taken place with an unrelated party. So if it is the Indian resident selling to Singapore, we check what price did he sell to others. If he is buying from the Singapore entity, we could find out what price is he buying from others. So there's an arm's length price, and we'll discuss the methods to do it under 92C. And once we find the arm's length price, we will apply that arm's length price to the transaction between associated enterprises to find out how much is the tax. So for example, if the selling price from the resident to Singapore entity is 100, but the same product is sold to an unrelated party for 150, we will apply the 150 arm's length price to the transaction and compute the extra 50 as profits in the hands of the Indian resident as per chapter 10. That is in itself one particular concept. What we also need to understand is, it is not just the Indian resident that is covered here. If the income of the Singapore entity is also accessible in India, for example, it could be royalty paid to the Singapore entity. Now, royalty paid is an expense for the Indian entity, but is the income of the foreign entity, and that foreign entity's income is accessible in India because royalty is always deemed to accrue or rise in India. So let's complicate it a little. If I say royalty paid by the Indian entity is 100 lakhs, now 100 lakhs will be allowed as a deduction to the Indian entity and taxable in the hands of the foreign entity. Now the foreign entity is taxable at 40%, let's assume, and the Indian entity is taxable at 30%. So what they do is, they reduce the royalty figure. Arm's length figure is coming to 200. Now, by applying the arm's length price, the expenditure of the Indian entity is increasing, their profits are reducing. Chapter 10 says, by applying the arm's length price concept, you cannot reduce the tax. Therefore, the royalty is 100. Indian entities claimed a deduction of 100. They've shown a higher profit. By applying the arm's length price, we can't reduce 200 because that will reduce the profits. But in this case, we will apply the ALP concept to the Singapore entity and say, your royalty is not 100 but 200, and we will tax you on 200. Are you following? So it can be applied to the resident or the non-resident both. But in this case, the Indian entity will get up and say, okay, you've now taxed the Singapore entity for 200. That means our expense should also be 200, so reduce 200. It's specifically written that if by application of the provisions of chapter 10, income of one party to the transaction is increasing, the income of the other party will not correspondingly reduce. That in a nutshell is chapter 10, basically computing arm's length price of every international transaction between associated enterprises to ensure that Indian tax is not shifted to other countries to avoid taxation in India. We will now go and understand this in detail. So what we've understood is, the basic point over here is to determine the arm's length price. Now it's easier said than done. Arm's length price. Now I'm exporting goods to USA, and you say the entity in USA and me are associated enterprises. I'm also exporting goods to a lot of other countries and a lot of other people in a lot of other countries. Now sometimes I'm giving a genuine discount. I'm selling in Switzerland at a higher price than in US because the Swiss people are ready to pay more, the US people are not, and they buy in bulk. So what is arm's length price? And it is not going to be easy to determine. So it's not a hard and fast black and white formula. So let's just understand the concept first. From the OECD model, he says the arm's length price of a transaction between two associated enterprises is the price that would be paid if the transaction had taken place between two comparable, independent and unrelated parties. Now the word is comparable, independent and unrelated parties. Now comparable becomes an issue. Let's say me and the entity in US are associated enterprises, and me and the entity in Switzerland are unrelated. The Swiss are buying 10,000 units. The US entity is buying 10 lakh units. Is this comparable? We are raising questions right now. We will have answers. So how do you compare? Because there could be, maybe Swiss people want a warranty for the product. The Americans don't want it. So my price is going to be very different based on a lot of factors. So comparable will need to be defined. Unrelated party, of course, somebody who is not covered by 92A is an unrelated party. So he says the transaction, the arm's length price is the price that would have been charged had it been with an unrelated party and a comparable transaction. So the arm's length price in the concept of taxation is explained in the OECD Model Tax Convention as under, where conditions are made or imposed between two associated enterprises in their commercial or financial relations, which differ from those which would be made between independent enterprises, then any profits which would, but for those conditions, have accrued to one of the enterprises, but by reason of those conditions have not so accrued, may be included in the profits of that enterprise and taxed accordingly. So OECD has been making these guidelines so that all countries, because every country is concerned that their tax is shifted to another country because of the difference in the taxation regime. So we have OECD, Organization for Economic Cooperation and Development. It's an international governmental organization with more than 36 country members who do this to try and ensure that all countries are at peace with their tax. Tax is not being shifted to other countries. But this one, he's just given a very vague meaning, which means a price that would have been determined between two independent parties had it not been between associated enterprises. It's going to depend upon a lot upon the facts of each case. And that's my motive to tell you. There is no one arm's length price. You've got to be thinking. In fact, when we do the formula of determining arm's length price under 92C, there are going to be so many different formulae. And even by applying one formula, you might get different arm's length price for the same transaction because there might be many comparable transactions. So import to US, associated enterprise, import to Switzerland, could be import to Sri Lanka, could be import to London. So many comparable unrelated transactions, and by applying each of them, there might be a different arm's length price. So what do you do then? And which is what this chapter is going to tell us. So he says, section 92 has been inserted to ensure that profits taxable in India are not understated or losses are not overstated by declaring lower receipts or higher outgoings than those which would have been declared by persons entering into similar transactions with unrelated parties in the same or similar circumstances, and where the application of the above has the effect of reducing the tax in India, then these shall not be applicable. I explained to you. Non-resident means a person who is not a resident, and for the purpose of 92 includes a person who is not ordinary resident within the meaning of clause 6 of section 6. So non-resident and R plus NOR are covered here as non-residents. So in simple, if I want to look at this chart, we say it is a transaction of incoming into India or outgoing. You could apply the provisions on the resident, you could apply the provisions on the non-resident, and there has to be an international transaction as per 92B. These guys must be associated as per 92A, and we will apply the formula of 92C. So three main sections: 92A, association; 92B, international transaction; and of course there is a 92C which gives us the methods. What we will understand is these provisions are applicable where at least one of the parties is a non-resident. At least one of the parties has to be a non-resident. But of course, when we do 92B, there is one exception to the rule where both parties are residents. Even then, in one exceptional case, provisions of this chapter will be applicable. With that in mind, let's move on. Okay, let's read section 92. Subsection 1. Any income arising from an international transaction. I've already said we'll do the definition. Essentially, it's a cross-border transaction. A transaction from India to outside India, cross-border, between associated enterprises, where at least one of the parties is a non-resident. And of course, what is the exception we will do later? Shall be computed having regard to the arm's length price, any income. For removal of doubts, it is hereby clarified that allowances for any expense or interest arising from an international transaction shall also be determined having regard to arm's length price. So he's talking about income, expenses or interest. For example, where an enterprise in India, let's say India, sells goods to an associated enterprise outside India, foreign, and these are associated enterprises, and there is sale for 250, whereas the arm's length price is 425. So he's shown 250 as the selling price, arm's length price is 425. Therefore, the income of the Indian enterprise will now be computed by taking not 250 but 425 as the selling price, and this difference will be now taxed as per section 92 and 92C. Similarly, an Indian enterprise in India purchases goods. So let's say foreign and Indian. This time there is a purchase, and these are associated enterprises for 50,000. So of course the expense shown is 50,000, whereas the arm's length price is 20,000. So we will now take 20,000 and this will increase the profit of the Indian enterprise. This is also covered here. Third, where ABC in India, so we say the Indian enterprise takes a loan. This is foreign and these are associated enterprises. There is a loan, and what the Indian enterprise is paying is interest. Even this interest will, he says, now be treated as an expense or outgoing, and that will also be determined at arm's length price, because you could increase the rate of interest and reduce your Indian tax. So he says is at 18%, whereas the rate at which such loan was available from unrelated party was 10%. So you've shown interest at 18%. He will now recalculate it by taking interest at 10%, thereby increasing your income. Subsection 2, where in an international transaction or he comes to specified domestic transaction. So there are certain specified high value domestic transactions which will be covered by 92BA. We will be talking about specified domestic transactions. Just to give you an idea, we in ATIA talked about inter-unit transfers where one unit is eligible for ATIA, the other is not. Similarly, 10AA. Now those are specified domestic transactions. If the aggregate value is more than 20 crores, then the provisions are applicable to the specified domestic transactions as they are to international transaction. But let us leave that for the moment. We will do that in topic 28.4. He says, two or more associated enterprises enter into a mutual agreement or arrangement for allocation or apportionment of any contribution, any cost or expense incurred or to be incurred in connection with the benefit, service or facility provided or to be provided to any one or more of such enterprise. The cost or expense allocated or apportioned to, as the case may be, contributed by any such enterprise shall be determined having regard to the arm's length price. Very interesting. So let's say there is a company X, this is in USA, and let's say there's an entity Y in India, and let's say there's an entity Z in Singapore. Now, X takes an order for, let's say, $1 lakh. And they say, we will distribute the receipts. Let's say 40% work is done in India, 30% here, and 30% here. So what happens is, in India, 40% of the receipts, which is $40,000, should be coming. Indian company has done 40% of the work, but what if they allocate 60% of the expenses here, so as to reduce the overall net effect of the transaction in India, so that overall group profit increases? They might allocate less expenses here because the profit in Singapore is going to be lesser. So he says, if this is done, we will be able to find out the arm's length price of the allocation of expense when you've taken a contract in a group, so that the profits shown in India by the Indian enterprise should be equivalent to 40% of the work that they're doing. It could be receipts are 40%, expenses are 60%. So it has to be at arm's length price. Of course, we'll go and do the methods. We are just reading the first section. Also, apportionment of head office expenses, everything will be covered by 92C. He says, any allowance for an expenditure or interest or allocation of any cost or expense or any income in relation to a specified domestic transaction shall be computed having regard to the arm's length price. Because in subsection 1, if we go and check, he had only referred to an international transaction. Specified domestic transaction was not mentioned there. Therefore, for these two, allowance for expenditure, he is given a subsection 2A, but the provisions remain the same. The provisions of this section shall not apply in a case where computation of income under subsection 1 or 2A or determination of allowance for any expense or interest under subsection 1 or subsection 2A or the determination of allocation of any cost under subsection 2 or 2A has the effect of reducing the income chargeable to tax or increasing the loss. So this is exactly what we've done in the first two videos. We've just read section 92. Now it's time to go and look at what is an international transaction, what is associated enterprise, and how do we compute arm's length price. So in the first topic we learned that an international transaction between associated enterprises will be covered by the provisions of chapter 10, which means we will compute the arm's length price to determine the assessable profits in India only if two enterprises are associated. Logically also, we are only going to be saying that if you are associated, there is some control, one exercises of the other. There is some interference in the price that must be inferred. Only then can we substitute the arm's length price to calculate your profits. Otherwise, as an independent businessman, how much I sell at, what price I charge is my discretion. At times I might sell at less than the market value. If I'm selling at less than the market value just to break the market, what did Reliance Jio do? They sold for 1 year free. No, but they were selling to, of course, the public at large. But suppose the AO gets up and says, no, you are providing free of cost, but the value of this transaction is going to be 400 per month and you have so many million users, I'm going to tax you on the profit. That seems absurd. So this absolutely must be understood, that the only case in which the AO can interfere to apply the provisions of the arm's length price to compute a profit is once there is associated enterprises and of course there is an international transaction. So section 92A has two parts, subsection 1 which is the general clause and subsection 2 which gives us specific situations in which two entities or two or more entities can be associated. We're going to go through each one of them to understand all the situations in which the entities can be associated. He says for the purpose of this section and 92 and 92B, C, D, E, F, associated enterprises in relation to another enterprise means an enterprise which participates directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. It's a very vague term. Participates. He says in respect of which one or more persons who participate directly or indirectly to one or more intermediaries in its management or control are the same persons who participate directly or indirectly or through one or more intermediaries in the management or control or capital of the other enterprise. Well, lots of questions can be asked here, lots of debate can come up, but we are not going to go into details because the CBDT clarified that while section 92A1 gives a general definition, 92A2 specifies circumstances in which two enterprises shall be deemed to be associated. So all we need to look at is 92A2. He says, for the purpose of subsection 1, two enterprises shall be deemed to be associated if at any time during the year. If at any time during the year, and let's go and check. Clause A. One enterprise holds directly or indirectly shares carrying not less than 26% of the voting power in the other enterprise. So equity shares. So example could be X company USA holds 26% equity shares of Y company India. Therefore, X and Y are associated enterprises. The question is at any time, which means if X and Y are associated only on the 1st of January of the relevant year, which means on that day X owns 26%, before that they did not. So does that mean any transaction before 1st of January will also be covered by this particular chapter? Because he says at any time during the year. The answer of course is yes. So if on 1st of January they become associated, transactions after 1st January till 31st of March or before 1st January between 1st April for that year will be covered by the provisions of Chapter 10. Please understand, we are not calculating total income here. We are only calculating, transaction, not the total income. Then any person or enterprise holds directly or indirectly shares carrying not less than 26% of the voting power in each such enterprise. So the example could be X company Germany holds 26% equity shares in Y Limited India and 26% equity shares in Z Limited USA. Therefore, X and Y, X and Z and Y and Z are all associated enterprises. Any transaction between them which has the effect of reducing tax in India can come within the ambit of Chapter 10. Now, so that was about ownership of equity shares. Now let's look at, he says a loan advanced by one enterprise to another enterprise which constitutes not less than 51% of the book value of the total assets of the other enterprise. So if there is one enterprise that is giving you a loan and the loan, he says, is not less than 51% of the book value of total assets, you are associated because there is an interest here. So GE Capital USA holds 15% shares in GE Capital India. There is no association because 26% is required. The total book value of assets of GE India is 80 crores. GE USA has given a loan of 42 crores to GE India. Therefore, GE Capital USA and India are associated enterprises. And as you can see, there is a or between each of the clauses. Then, D part takes care of when loan is not given but a guarantee is given. So, because if you are giving a loan, you are associated, what happens is one enterprise guarantees not less than 10% of the total borrowing of the other enterprise. Gross bracket Germany has guaranteed the borrowings of 10 crores made by Sheetal Needles India. Total borrowings of Sheetal Needles is 80 crores. Therefore, these are associated because guarantee is not less than 10%, which it means it is more than 10% of the total borrowing. Therefore, gross bracket Germany and Sheetal Needles becomes associated enterprises. Then he says more than half of the board of directors or members of the governing board or one or more executive directors or executive members of the governing board of one enterprise are appointed by the other enterprise. We know there are board of directors, and he said more than half of the board of directors, or we also know there is an executive board, people who govern on behalf of the board, even one of those members, if are appointed by the other enterprise, and the question over here is are appointed. He does not say has the power to appoint, he says are appointed. So if I take an example, he says A Limited and B Limited will be associated if A Limited appoints 5 out of 8 directors of B Limited, more than half, or appoints 1 executive director, or appoints 1 executive member in the governing board. In either case, both of them become associated enterprise. Then he says more than half of the directors or members of the governing board or one or more of the executive directors or members of the governing board of each of the 2 enterprises are appointed by the same person or persons. So this is now indirect. So for example, we say X Limited USA has the power to appoint 5 directors out of 8 directors in Y Limited India and 10 directors out of 15 directors in Z Limited UK. But he has the power to appoint. Unless the power is exercised, there is no association. But let's say he has, or the company has appointed 5 out of 8 directors of Y Limited and 10 out of 15 in Z Limited, more than 50% of each, then all 3 become associated enterprises. An executive director of Y Limited and an executive director in Z Limited, this will become associated. An executive director in Y Limited India and 10 directors out of 15 directors of Z Limited will become associated enterprises. 5 directors out of 8 directors in Y Limited India and an executive director of Z Limited in UK. So whichever way combination is there, then these become associated enterprise. But please remember, they will become associated only once the power is exercised. If you have the power which has not been exercised, then the association will not be there. This one becomes even more interesting. He says the manufacturing or processing of goods or articles or business carried out by one enterprise not just manufacturing, or business carried out by one enterprise is wholly dependent on the use of know-how, patents, copyrights, trademarks, licenses, franchise, or other business or commercial rights of similar nature, or data, communication, drawing, specification relating to any patent, invention, model, design, secret formula, process of which the other enterprise is the owner, or in respect of which the other enterprise has exclusive rights, then they are associated enterprises. So it could be a company in USA which has the right to maybe show movies, and the company in India has the exclusive right to show those movies, and the entire business of the company in India depends upon the right they have from the company in USA. They become associated enterprises. So it is not just manufacturing, it could be any business where the business in India is wholly dependent on the use of know-how, patent, etc., of which the other enterprise either is the owner, or the other enterprise has exclusive rights to use, which of course you are using in India. So technically the words used are wholly. So if we say X Limited manufactures soap and toothpaste in India, the soap it manufactures is patented by Y Limited in USA, for which X Limited has acquired the rights to manufacture the same in India. We cannot say that X's entire business depends upon the patent, because they are also manufacturing toothpaste. So we can say they are not associated enterprises. But of course, we'll have to look at the facts of the case more into detail. Tomorrow it should not be a case where toothpaste is just added as a manufacturing line to escape the provisions of transfer pricing. Then it says X Limited manufactures soaps in India only, and the soap it manufactures is patented by Y Limited in USA, for which X Limited has acquired the rights to manufacture the same in India. X and Y of course are associated enterprises. Now he says 90% or more of the raw materials and consumables required for the manufacture or processing of goods or articles carried out by one enterprise. Now this one is only applicable to the manufacturing business, are supplied by the other enterprise or by persons specified by the other enterprise. So 90% of the raw materials required are supplied by the other enterprise or by any other person specified by the other enterprise, and the prices and other conditions in relation to supply are influenced by such other enterprise, then these are associated enterprises. For example, he says X Limited of USA of India buys 9.5 crore worth of its raw material from Y Limited in UK. The total raw material purchased during the previous year of X Limited amounts to 10 crore, which is more than 90%. So X and Y are associated. He also says if Y Limited directs Z Limited to supply 9.5 crore of raw material to X Limited and influences the price in other terms, then also X and Y are associated enterprises. There are other terms over here like guarantee, warranty, after sales. There are so many other terms. So it is not just the price and other terms. So anything that is influenced by the other enterprise, they will be associated enterprises. Now, goods or articles manufactured or processed by one enterprise are sold to the other enterprise, or to persons specified by the other enterprise, and the prices and other conditions relating thereto are influenced by such other enterprise. Now in case of purchase of raw material, remember it has said more than 90%. In case of sale, it does not mention a percentage. So it could be inferred that any sale wherein prices are influenced is going to be covered by 92C, which means the arm's length price, which means there are associated enterprises, because he says the goods manufactured or processed by one enterprise are sold to the other enterprise or to a person specified by the other enterprise, and the prices and other conditions relating thereto are influenced by such other enterprise, the person buying. Therefore, these are now associated enterprises. He's keeping it open so that he can catch hold of anybody who's trying to influence prices and take away the profits of India outside India, where one enterprise is controlled by an individual. The other enterprise is also controlled by such individual or his relative, or jointly by such individual and relative out of such individual, then these are associated enterprises. So Mr. X is a businessman in India and he is holding 60% shares of Y Limited Singapore along with his wife. Now Mr. X's sole proprietary concern and the company in Singapore are associated enterprises. Similarly, where one enterprise is controlled by a HUF The other enterprise is controlled by a member of such HUF or by a relative of the member of such HUF or jointly by such member and his relative are also associated enterprises. For example, X HUF is doing business in India and it along with its members is holding 60% shares of Y Limited Singapore. Now, X HUF and the company in Singapore are associated enterprises, where one enterprise is a firm, AOP or BOI. The other enterprise holds not less than 10% interest in such firm, AOP or BOI, then also these are associated enterprises. And lastly, there exists between the two enterprises any relationship of mutual interest as may be prescribed. So, in all these cases, there could be what they call associated enterprises. Now, let's just go through this one by one so that we can memorize this. First one, he says, where one enterprise holds 26% or holds in two, they are associated enterprises. A loan given which is not less than 51% of the book value of the other enterprise, or a guarantee of loan which is not less than 10% of the total loan taken of the other enterprise, both are associated enterprises. So 2 plus 2, more than half of the board of directors of one enterprise are appointed by the other enterprise, or even one member of the governing board is appointed, or one entity appoints in both the other entities more than half or one, more than half or one, then these are associated enterprises. So 2 plus 2 plus 2, that is 6. Then the business of manufacturing of one enterprise depends wholly on the patent, copyright, trademark which is owned by the other enterprise or of which the other enterprise is the exclusive right holder, then these are associated enterprises. So we'll keep this separate. The next one is where 90% of the raw materials of one enterprise are supplied by the other enterprise or by someone authorized by the other enterprise and the prices are controlled by the other enterprise, or goods sold by one enterprise to the other enterprise where the other enterprise influences the prices and other conditions, then these are associated enterprises. So that is 2 plus 2 plus 2 plus 1 plus 2, where one enterprise is controlled by the individual, the other enterprise is controlled by the individual or his relative or jointly by the individual and his relative, where one enterprise is controlled by the HUF, the other enterprise is controlled by the members of the HUF or the relatives of such members or jointly by the HUF and the members and the relatives, then also there is associated enterprises, where one enterprise is a firm and the other enterprise owns at least 10% or more than 10% of the interest share of profit in the firm, then these are associated enterprises. Any one of these conditions becoming fulfilled, the provisions of 92C may apply, but then there has to be an international transaction. So let's go and understand what is an international transaction. So question in November 18 to test whether you've understood the provisions of section 92A or not. Let's read that. State with reasons whether Nelton LLC, so we have Nelton LLC and this is incorporated in Singapore, and Briggs Limited, so Briggs Limited, which is a domestic company, so of course this is a resident of India, are or can be deemed to be associated enterprises for the transfer pricing regulations. Each situation is independent, so these are not connected situations, these are independent of the others. Now he says Nelson LLC advanced a loan of 53 crore on 12/1. The book value of the assets is 100 crore. So the book value of assets is 100 crore. The market value of the assets is 150 crore. Briggs Limited repaid 10 crore. So there is a repayment of 10 crore before 31st of March. Are these associated enterprises? So there was this clause which says a loan advanced by one enterprise to the other enterprise constitutes not less than 51% of the book value of the total assets, of the book value of the total assets of the other enterprise. So if we go back, the loan advance is 53, and remember the words were at any time during the previous year. So even if the loan is repaid, doesn't matter. At one point of time, the loan advanced was more than 51% of the book value. So the market value is of no relevance. Therefore, Nelton Singapore and Briggs Limited Domestic Company India are deemed to be associated enterprises as per section 92A. Then he says Nelton LLC has the power to appoint 2 out of the directors of Briggs, whose total number of directors in the board is 4. So Nelton and Briggs, he has the power to appoint 2 out of 4. Well, the first point over here is the power to appoint till the time exercise will not amount to associated enterprises. Plus, the condition was more than half. He has the power to appoint 2, which is equal to half. He doesn't have the power to appoint more than half. Therefore, these will not be associated enterprises. So 2 points we'll address here. Power to appoint should actually be appointed, and then the second part is that it should be more than 50%. So 2 nahi, 3 hota to theek tha. Total value of raw materials and consumables of Briggs. So Briggs and Nelton again. And these are, he says, remember, separate situations. He says the total value of raw material and consumables of Briggs of 900 crore. So total value is 900 crore. Of this, 820 crore is provided by Nelton, which is more than 90%, remember, of the raw material. Then he says at prices mutually agreed upon once in 6 months and depending upon market conditions. Okay, here we go. Remember what that clause said? That clause said that if the supply of raw materials exceeds 90% of the total supply and the prices and other conditions are influenced by the other enterprise, then these are associated enterprises. In this case, the prices are mutually agreed upon. So how can they be associated enterprises? The question is, they are not influencing each other. It's a normal arm's length price transaction. So these are not associated enterprises. So as you can see, the questions are very simple, pretty simple. Once you have the basics in your mind, the idea would be to gain the marks. And to gain the marks, you must first describe the provisions, then compare it to the situation and give your conclusion. So what is an international transaction? From the very word international, I'm sure this has to be inferred to mean there is a cross-border transaction, which means a transaction between somebody in India and somebody outside India. Now, this is going to have 2 subsections. So we're going to look at 92B subsection 1 and 92B subsection 2. 92B subsection 1 says, for the purpose of this section and sections 92, 92C, 92D, 92E, basically for all of transfer pricing, international transaction means a transaction between 2 or more associated enterprises, either or both of whom are non-resident. So at least one of them must be a non-resident. But he says even if both of them are non-residents. So if there is a transaction of lending money between one non-resident and another non-resident outside India, and the money is used by the borrower in India, then remember the income of the lender by way of interest is also deemed to accrue or is in India. And this can also be subject to the provisions of transfer pricing. So maybe the lending has taken place at 2%, whereas normally the money lender lends at 10%. And in the example, the lender and the borrower are both associated enterprises, and income of the lender is accessible in India, and it can be subject to arm's length price because you've shown interest at less than the price at which you are lending money to the other people. So even 92B will say that this is an international transaction, and as per 92A, these are associated enterprises. Therefore, as per 92C, we will apply the arm's length price to calculate the profits or income accessible in India of the lender. So he says, international transaction means a transaction between 2 or more associated enterprises, either or both of whom are non-residents, in the nature of purchase, sale or lease of tangible or intangible property. Purchase of property, lease of property, sale of property, tangible property or intangible property, or the provision of service, or lending or borrowing money. or any other transaction having a bearing on the profits, income, losses or assets of such enterprise, and shall include a mutual agreement or arrangement between the two or more associated enterprises for allocation or apportionment of, or any contribution to, any cost or expense incurred or to be incurred in connection with a benefit, service or facility provided or to be provided to any one or most of such enterprises. So three things. If there is an international transaction, which could be for purchase or sale of tangible, intangible property, lease of such property, provision of services, lending of money, or any other transaction which could mean apportionment of expenses or apportionment of costs which have a bearing on profits in India, will be covered by the definition of international transaction. Now let's do 92B subsection 2. He says a transaction entered into by an associated enterprise with a person other than an associated enterprise. So this is a transaction by one associated enterprise entered into with an unrelated party. Abhi tak 92B1 said that an international transaction has to be between associated enterprises. 92B subsection 2 is saying that even a transaction between an associated enterprise and an unrelated party can be an international transaction. Let's see what he says. Shall for the purpose of subsection 1 be deemed to be an international transaction entered into between two associated enterprises if there exists a prior agreement in relation to the relevant transaction between such other person and the associated enterprise, such other person and the associated enterprise, or the terms of the relevant transaction are determined in substance between such other person and the associated enterprise, where the enterprise or the associated enterprise or both of them are non-residents, irrespective of whether such other person is a non-resident or not. So he says there are two associated enterprises. One of them could be a non-resident, both of them could be a non-resident, doesn't matter. The other enterprise is the enterprise with which one associated enterprise is getting into a transaction. But the price of that transaction is influenced by the other associated enterprise. Therefore, this transaction between unrelated parties will also be deemed to be an international transaction and be covered by the provisions of 92C, which means the price of this transaction can now be subject to arm's length price. For example, let's say B Limited is a resident Indian company. A Limited is also a resident Indian company. C Limited is a foreign company. C and A are associated enterprises. Now B supplies raw material to A. One transaction during the year, and that transaction there is a sale of 10 CR. The price is influenced by C. B usually sells it for, let's say, 15 CR. Now you can only apply the arm's length price if there is a international transaction between associated enterprises. Now B and A are not associated. It's not even an international transaction because it's in India only, between two residents. 92B1 says that at least one of the parties should be a non-resident, but 92B2 says that even if both are residents, but the price is influenced by an associated enterprises which is a non-resident, then this transaction between two residents will also be deemed to be an international transaction and arm's length price provisions will be applicable. Now just to summarize this, we say that if there is a international transaction which is defined under 92B between associated enterprises, then the price of that transaction can be found out by using one of the methods given under 92C. We call it arm's length price, a price which is not influenced, because we believe that if there is an associated enterprise and there is that international transaction, then you manipulated the profits to show reduced tax in India or increased loss in India or apportioned extra overheads in India, so as to thereby reduce the income of either of the parties to the transaction which is accessible in India. By replacing the actual transaction price with what we call the arm's length price, income is going to be increased. This chapter cannot end up reducing the income. This chapter can only result in increasing tax. And of course, the income that is increased will be subject to penalty as well, which we will discuss as we move on. What we now need to look at is a little bit more detail of what an international transaction can cover. Then of course we'll end up doing 92C, and then of course we'll look at how the calculations are done for the practical questions. Let's do that. So having looked at the meaning of international transaction, remember I talked about sale or purchase of tangible, intangible asset, leasing of assets. Now we can't go through all possible situations, but just try and imagine it. There is of course an international transaction between, we said one party is a resident, the other is a non-resident, or both could be non-residents. And of course the exception was 92B2, wherein even a transaction between two residents could be covered, which are not associated could be covered. But let's concentrate on 92B1. He says purchase, sale, transfer, lease or use of tangible property. Now he says tangible property could include building, could include transportation vehicle, could include machinery, equipment, tools, plant, furniture, commodity or any other article or product or thing. So look at a building in India which is owned by a resident, and they sell it to a non-resident which is an associated enterprise. Is this going to be subject to the provisions of 92C? He says yes, because purchase and sale or transfer of tangible property is covered. So maybe you are selling it to the non-resident at a lesser price to avoid capital gains tax in India. That can be now redone or recalculated by using the arm's length price. There is a non-resident who's leased a machinery to a resident in India for use of their exploration business in India. These are associated enterprises. Now, the rent in India is kept higher so that the resident's income becomes lesser. The non-resident's income might not be taxable in India because there's a DTAA. So any number of combinations can be possible. We are not going to look at each situation because these are complicated international situations. You'll have to look at whose income is being assessed in India, because the manipulation will depend upon whose income. So for example, if I say there is a lease from a non-resident to a resident, let's say the resident in India is a domestic company taxable at 30%. The non-resident is a foreign company taxable at 40%. What they can do, the lease rent, remember, is covered by section 916. So the income of the non-resident is also assessable in India. The income of the resident is also assessable in India. What are they trying to do? They are trying to reduce the overall taxability. So they might say, okay, let's show the lease rent less than the market price. So if the market price is 100, let's show it at 70. In effect, the income of the non-resident is now being taxed at 70, which is at 40% rather than 100 at 40%. And the domestic company will get a deduction of course of 70, not of 100, thereby increasing their income by 30. But that 30 is going to be taxed at 30%. So they are saving 10% tax on 30. Are you following? Now in this case, because they are associated enterprises, there is an international transaction, the arm's length price of the non-resident will be reworked and said this is going to be at 100. So they can't save tax over there. Then the domestic company gets up and says, okay, since you've told us that the income of the non-resident is 100, our expense should also be 100. Well, the section will say, no, your expense will remain at 70. Why did you manipulate? So all that we will keep doing as we move on, but you'll have to keep your mind open to what an international transaction is. It could be purchase, sale, lease, transfer of tangible property or of intangible property. And again, it could be either ways. An Indian resident and a foreign non-resident who are associated enterprises could be sharing TV rights, could be sharing movie rights. Again, manipulating it in such a way the income overall is reduced. But these provisions will be applied only to increase the tax of one party. The corresponding tax of the other party cannot be reduced by claiming the benefit under 92C. He also says copyrights, patents, trademark, licenses, franchises, customer lists are being shared. Marketing channels are being shared. Brand, commercial secrets, know-how, industrial property rights, exterior designs, practical and new designs, any other business or commercial rights. He's just being very careful. He says any lease of intangible property, including transfer of ownership or provision for use of certain rights. Anything will be covered here. He also says any type of long-term or short-term borrowing between associated enterprises, lending or guarantee, purchase or sale of marketable securities between them, any type of advance payments or deferred payment or receivable or any other debt arising due to the course of business between the associated enterprises will be covered here. Provision of services could include market research being carried out by one of them, market development, market management, use whatever word you want. It's provision of services, administration, technical service, design, consultancy, agency, legal or accounting service. If A Limited and B Limited are associated enterprises and A Limited is just giving legal advice to B Limited, even that is a international transaction, the price of which can be covered by 92C. So these elaborations are more relevant in the practical world when you're going to the minute detail. But for us, everything comes within the definition of service. He says business restructuring or reorganization entered into by an enterprise with an associated enterprise. It could be a firm being incorporated into a company. So business reorganization is taking place wherein an Indian firm says we are now going to become a subsidiary company and there is a foreign holding company that is going to be formed. That is business restructuring. That is also a transaction. If there is any profitability that is accessible and it is being manipulated during the course of this business restructuring, it will come within the definition of international transaction. What we are trying to understand is that international transaction is any type of purchase, sale, lease of tangible, intangible property. Could be borrowing money, guaranteeing, could be apportionment of costs, overhead, provision of services, will all be covered within the definition of international transaction. If I look at some of the past year's questions from this definition, he's only asked us discuss the concept of arm's length price as envisaged by 92C. So that's an overall question asking you the same old, it must be an international transaction between associated enterprises and the arm's length price can be recalculated. When a transaction shall be considered as an international transaction. In what circumstances a transaction entered into with a person other than an associated enterprise shall be deemed to be a transaction between two associated enterprises. This of course we know is 92B2. Write short note on international transactions. So these are questions that were asked when this chapter was introduced. Nowadays what we are looking at is more questions on the calculation of the arm's length price, which is what we are going to be doing in the next topic.